Hello and welcome to the End of the Chain. I'm your host, Samuel McCulloch. This week I am joined by a repeat guest, actually. I have Patrick Dugan back to talk about the recent price movement and the Bitmex blowup and potentially the conspiracy to cover it up. So it's a fun chat. I always enjoy hearing Patrick's ideas on the market and what's actually going on because he was one of the first people that I talked about that was very interested in interest rates and how they applied to cryptocurrencies. And it was pre-warning to a premonition about what was going to happen with DeFi in the next few months and in the year that came. So really happy to have Patrick on. Always a great guest. And so also make sure to come give a DAI or two at the End of the Chain Gitcoin grant. We're up and running. You can support this show and everything that we're doing here. And that's all I got. So let's hop into the episode. Welcome, everybody. I'm here with Patrick again. Patrick's joined me because I want to get his thoughts on what happened in the markets over the past few weeks. So today is March 20th. Bitcoin is ripped back up from lows at 36.38 all the way back up to 66, right? But what I want to start with is the I guess it's a conspiracy put forward by who's the guy who runs FTX?
Sam.
Yeah, Sam from FTX.
Sam
right?
Bankman.
Yeah, so a lot of this comes from him. There's also some other people who I follow on Twitter who I kind of glean this from. A guy named Bitcoin Theory who has some really nice insights. And it seems the overarching okay, so let's just go back. On March 11th, there was a catastrophic downside margin call, just push, right, of 281,000 Bitcoin that was sold off by looks like professional traders. And it took the price of Bitcoin so on March 7th, we were trading at 9,150. And at March 13th, we were trading at 35 at the lows on Bitmex. And it was a mixture of both dumping on spot exchanges and then also just taking large positions on MEX as well, too.
Because if you're actually moving the markets and you can move the markets with probably half or a third or a fifth even of spot quantities than your actual derivatives position. So you start out hedged, dollarized, you might say, then you start to get a little net short as you sell, or you could have a net short and you get net shorter. So you get some positive convexity, which is amplified, I guess, well, not really in dollars, but it's amplified a little bit, I guess, by the inverse quoting.
Yeah. So just to come back, so the pricing on Bitmex has no it's correlated with spot, but it can be pushed way far away from spot. So,
and what happens is the tail wags the dog. So if you push the Bitmex swap down to negative 10 basis points or lower, then anybody who has access to the spot arbitrage pool of lent BTC that you can get through Genesis or Paxos or a lot of offshore OTC desks can go ahead and borrow it for like 5% PA or 7 maybe, but probably not. I mean, they're very competitive, right? You have some tenor risk. You have to take it on for 30 days, whatever. But then you go ahead and you sell it. You try to get a good execution. But if the spread's blown out, you pay market. You'll pay the stupid 20 basis points on you probably have a good fee deal as well.
I mean, but this is what happened on. Okay, so the price just kept on getting pushed and pushed further down, right? Which pushed the rate on Bitmex further negative. So it was incentivizing people to bid, essentially, because the market was just going completely fucking bonkers.
Which incentivizes those who can to borrow and spot short BTC, even paying market, moving the bid, paying the stupid fee, which is way too high, but okay. But they're getting filled. They're bidding on the swap as it lunges to negative 50 points, et cetera.
Right.
And it got so dislocated with the rest of the futures, it was actually trading like 5 or 6% raw, pricing in a maximum payment to the long. So because the interest
Let's go
formula,
back. So the
yeah, that's
spot was
later in the
trading
night
five. Yeah. This was later in the night.
when it got that bad. Yeah, but go
Yeah.
on.
So
So
spot.
let's take the story through. Let's go through
Right.
the.
It's around like sub 6,000 is when things started to really dislocate. So at that point, uh, the separation between, say, Coinbase and Bitmex just broke apart, and Bitmex just started getting pushed lower and lower. The spread started getting wider and wider, and so the hedge that you're talking about right there, which is to bid the swap and then short the short spot, right? It just started getting destroyed, and it turned into this kind of rolling margin call on the bids on Bitmex, right? Because there was no liquidity. The market makers just disappeared for one. So there was zero liquidity. Nobody was bidding, and it just kept on pushing lower and lower and lower.
Yeah, a
And
comment on the background with that. So the total open interest in the swap might have been around $1 billion at this time, right?
Right.
Whereas the total open interest in BitMEX futures and the other futures are like maybe in total a double on this. Might have been like 3 to 500 million between the two tenors that they have for futures. Yeah. So, and a lot of that futures positioning are people who aren't risking the whole cow. They're taking on a basis trade. For instance, they're shorting it and then they're buying the swap instead of borrowing it from Barry Silbert, right? And doing it spot. And then they actually make more money because of, in this case, it's actually a risky thing to do in most dips where you'll have a little perp funding paying longs. But because, of course, any reversion, you get smacked, you go back to zero. In this case, it went all the other way. But those guys are not in danger of going bankrupt because they're risking a few percent of their accounts on basis moves. But for the perp, it's like the retail guys just bought into this. I always hear from these young guys who trade XBT, oh, wow, the funding really ate me up. They hold a long for months, and then they come back. Oh, right. Okay. So maybe it's a little more complex. It's like a complex derivative posing as a simple derivative. And a lot of longs, just naked longs, are in it, and they were getting wrecked. Therefore, it's not supposed to go -6, right? The futures are supposed to go -6 so that you can maybe take some risk shorting them there and buying the perp at -1 or -2 at the most, right? And then you'll be back at -0.5 within an hour, and you wait, and then it's still paying the maximum, right? So because they capped the interest rate with these outer brackets, right? So you've got the inner brackets, the clamp, and the normal arbitrage between perps is really all about the clamp, right? So Deribit has a zero clamp. You can park in Deribit either side, and then you arb some other perp. That's interest rate arb. And interest rate arb is all about execution cost and then a few basis points of differential that wobbles. And, that's the day-to-day bread and butter liquidity. So a lot of this volume that are in perps are people taking advantage of these intraday interest rate divots and these like microsecond or millisecond long divots and basis points, right? That's the core market structure we have today. And there's obviously relativistic latencies because you're around the world. It's not that big. The bottleneck latency of a couple hundred milliseconds, or we're tens of milliseconds maybe, but we're talking about a very different time scale than what like New Jersey BATS equity trading goes on with. But okay, so we can get to that. I think that's going to be in our future. Relativism notwithstanding, relativity. Sorry, like it's like 80 microseconds or something between furthest points. So whatever, right? So when we're getting into hundreds of microseconds, that might be where market structure goes. But right now, it's these guys kind of trying to play this guessing game at a quantum scale, you might say, for quoting. And when this gets knocked out, and then of course Bitmex is still the 800-pound gorilla. It's still the center of gravity in this solar system of swap trading, and there's a lot of little Kuiper belt objects like these third tier exchanges. Yeah, go ahead.
So on March 12th, right?
Yeah.
As soon as we passed under, what is this? Like the 5,000 mark.
Yeah, so you had the first dump at 7:30 in the morning, and that was like a what would be like a 5 sigma move for stocks, and it was like a 2 point something sigma move or 3 sigma maybe for Bitcoin, right?
It was a $1,200 move or a $1,500 move.
Yeah, so I just for a little color on my part, before we have some minutes to make this day be like a full episode of the Twilight Zone here. So my story is I've been in hedges for Tradelayer Treasury because I take it very seriously, not to lose a dollar, more than the FOMO of like, what if I don't have a Bitcoin at 100K, right? Um, and anyway, so I was fully hedged. I was short perps at 9K as we rolled over that round number bias is very powerful. It's the most popular world religion. And I remember seeing it go from 7 basis points per 8 hours, because it's a real time thing with Deribit, to 0 right as the spot was dipping under 89, 97. It goes whoop 0. And then when we had a clean break under 9K, it stayed 0 until approximately this move, or maybe a little bit before it started going a little negative. But Deribit's nice; it tends to stay at 0 most of the time. But this was what you might call a normal break in the markets. And I'm looking at Bitmex. There was $1 billion, 1.23 billion in volume. I can only look at the 30-minute candles here on Bitcoin Wisdom. .io. Give this guy some props, guys. It's classic. If you remember 2014, that's why I still use Bitcoin Wisdom, because it's got that vibe, man. So anyway, so yeah, that's a lot of money. And if I look at like Binance, so the other thing we have to factor in here, and this is maybe a future black swan, is that Tether is sort of a swap market also, but it just doesn't have an interest rate. So it's kind of like a perpetual future that they've like written themselves, essentially. Because it's accounts receivables. There's some fractional reserve in it, just like the billion-ish in Bitmex swaps are not 100% fully collateralized by Bitcoin that people have sitting on, right? The ratio might be better in actually with Tether, and that's why Tether didn't go endangering the whole market complex. It was Bitmex, right?
Right.
But okay, looking at Binance on the 30-minute, I'm going to go back to this candle just so we can get an anatomy here. So it's like there's 3 volumes you want to look at. You want to look at the swaps, futures follow swaps. You want to look at the Tether, which is the pseudo swap dollar, and then obviously the sort of hard regulated dollars, which is usually the least, right? But a bigger number there is sort of there's some sort of leverage in that for analyzing this. So we only had 22,918 on that candle over on Binance USDT. So what's that in dollars real quick for me? You gotta
22,000 Bitcoin.
Yeah, and some change. Yeah, 819. And what was the average price? It was about where we are right now, funnily enough, which is kind of why I'm hedged right now.
66, 22.
Yeah, it was. Let's say this is the median price for that candle. So yeah, that's
$130 million.
Yeah, 151. Okay, so that's not as significant. Yeah, okay, so this kind of supports the thesis of Bitmex really being the killer whale here. So we can tell already that there were like a few hundred million worth of liquidated longs in that candle, probably, right? Because that was an unexpected move. And on my part, I had dipped into an interest rate arb to get a little extra yield, and I had some coin over on EMX, and I was buying. I think I was buying swaps and whatever. Or no, actually, I think I might have been shorting swaps. Funnily enough, they were still paying. And I was like buying futures, or it might have been the other way around. Who cares? Anyway, I was a little off on my net delta, and it was like too much margin, and I was very greedy for what in retrospect was a very small swap payment. And right. And so I was, reducing the position, and then I had like a 0.15 BTC lip left over, which is very little, and I thought it was fine. And my liquidation call was in the low 5s. So I go to bed with that, and then I wake up and I go, oh my God, what? No way. It actually went down there. And it wasn't like I'm naked long where I'd be like, oh, bro, that's so much money, right? But I checked in. I had I got liquidated both sides. I had multiple liquidation fees, but the slippage was worse than the liquidation fees. Ugh. So I gave back like 2 and some change percent on the sort of like the costs of the liquidation. I didn't have much of a net position because this was a box, but so I just had a curve position that was working for me over on Derb. but yeah, a little delta slippage, but that was the smallest of it. So I was like, oh, what a bad day. I lost money, right? And then I'm going through most of my day kind of pissed off about this. And then by the end of the night, the climax of the story, I took advantage of the apex of what we're talking about when this outage happened and the market structure breakage stopped. And we had a sharp reversal, and we had like a 3.5 sigma rally or whatever. There was one last October. You fun thing about Bitcoin, you do get these 50% in like N hours rallies over every now and then.
Do you think could these people have pushed MEX to zero or like $1?
Well, let's get to that. Let's go through the play by play.
Right. Okay. So
let's give it a narrative. Yeah.
So, let's go back. So
phase one, everybody's wounded, right? And we're all like, oh no,
phase one happened. What back on phase one happened when it broke 9,000.
Yeah, like the 7:30 candle.
No, that was the 7th of March at 11:25. It like violently broke. We had
over in Russia 11:25.
Is it me over? Oh no, I'm UTC -4 here. I'm looking at the chart. So
okay.
I'm back on the 7th of March, right? So that was when we broke 9,000, and pretty clean from there, right? And then
it's sort of like, oh shit, guys. Well, hey, here's some moving averages on the weekly. Right. This could be support. Like we're gonna rally. Like what I was kind of looking at is, are we gonna rally back from low sixes to above that line? Right. And the next really long-term fib MA, which we didn't even touch last low at 31.28. I'm looking at Coinbase right now. It's currently at 48. So we could possibly retest that. And we just kissed this other MA at 71-ish. So anyway, so we were there, and it's like, maybe we'll come back. This was a big move for Bitcoin. It's bigger than the S&P. And probably if we had better market structure, just to make this relevant to the overall plot here, if we had better market structure, that might have been, obviously we kept going down in the stock market, but it was at night, right, when this was going down. So it has almost more to say about what happens when Bitcoin isn't correlated to the stock market and is left to its own devices. Well, we're really left with the market structure that we have. God help us all. So then later in the night, so the Asian open hour, as I like to call it, is often a very good hour for taking short-term positions and making trades, because you'll see 1 or 2 hours where there's a big move up or down. Sometimes it's a hairpin and you kind of end up flat, right? But it's an expression of new energy and derivative flows and possibly spot flows and tether flows. A lot of these guys hold tether, right? So tether becomes more relevant in terms of printing the market, maybe. Although I guess there's a lot of MEX traders who are in that time zone. Anyway, so yeah, it was in that Asian open hour that we had. So we had a little dip in the early afternoon, or the late afternoon. Sorry.
What time was this?
So my time, it would have been 5. Would have been like, I guess this was right after the time zone shift. So it would have been like 4 in the U.S. 5. So in those hours,
4 or 5 in the morning. That's when so on the 12th. At about 4 or 5 in the morning, that's when we had the big dip down from 7,000, or like 8,000 down to the 6,000s.
Yeah. Do you have a chart of S&P comparing to Bitcoin, just so we can observe the correlations visually? I'm pulling one up on TradingView right now. It might take a minute. TradingView is a little slow to load, guys. Just kidding. Trashing TradingView. Not really. They're okay. They finally added Deribit, so I can't really sandbag TradingView too badly. But yeah, the point is the S&P wasn't ticking. I guess ES is ticking in Globex in this time.
Well, I'm looking at the S&P, right? So there was I'm looking at the SPX. I brought up the wrong thing.
Oh, well, notably, I foolishly posted a chart of this ratio of the SPY ETF for simplicity to Bitcoin, and it popped over 31. So that would be like you can buy 31 shares of it with 1 Bitcoin. And then it plunged on the daily close. So here I'm seeing basically when the market was open to 19, and then just based on that stale closed market quote, because obviously this doesn't trade after hours too much. I mean, it does a fair bit, but it's not like ES and Globex, right? But anyway, Yeah, we got down to 16 by the lows, or 15.84 shares of SPY per Bitcoin. Or you sell 16 shares and you buy a Bitcoin, right? No, that doesn't sound too bad.
The first sell off. So I'm looking at the SPOs, right?
And just to finish that point, now we're at 27.40 on this chart. So we're on the low end of the range that we were in since early February, and we're back in the range. Actually, I mean, the truth is we were at 20 shares to one corn back in mid-December, when we were having some troubles as well, right? So it is what it is. So actually, this is kind of a decent range until we get into a true net inflow situation and, gain a level on Bitcoin, add a zero. We're in a totally different range, which is a whole process for Bitcoin. Of course, we want to be positioned long when we recognize that process happening. If you're a little late, it's not the end of the world as long as you manage your risk and don't lose your coin trying to leverage it. Yeah. But anyway, meanwhile, we were up in the 45 and 30s back when we were over 10 to 14K, for example. Right. And we were in the 19 to 11.8 or 12 back in the doldrums of last year.
This is the ratio of Bitcoin to S&P.
Yeah. So anybody can go type in BTCUSD/SPY on TradingView for free and look at it daily.
Okay,
yeah, exactly. So go ahead.
Okay. Okay. So I'm looking back. So on the 6th of March, that was limit down, actually.
Yeah.
No, there was limit up. Is it limit up? Looks like limit up, and then there was an immediate limit down, which occurred after that, and then there was a second limit down. So the first like break, right? Or is that over the weekend? It's over the weekend. Yeah. So the break happened over the weekend on the 7th. Markets opened up, immediate limit down. Bitcoin came down as well too to 7,500. And then
on March 7th.
Yeah, or the 9th. The 9th there was
yes. Yeah, that was just the warm up though. Yeah.
Yeah, just the warm up.
That's just like, we're just used to that. We're like, okay, go risk off for 2 or 3 days, let Bitcoin do an 8er or a 12er, and then we'll get long again. Yeah. But no, it was not to be. Yeah, go on.
Yeah. No, but then the real fun started happening with Bitcoin when it broke 4,000 or down into the 4,000, 5,000, right?
Yeah, so we have markets closed, Asian open, and we have a 1 hour candle. I'm going to zoom into 30 minutes just for.
So I'm looking at the 5-minute candles, right?
The thing they got to appreciate that some of this shit happens in 1 minute, man.
Right. Exactly.
I mean, it's unbelievable.
But the real dislocation started to occur on the 12th of March around 6:50 New York time, or 7 o'clock New York time, and that's really when things started to disconnect. That the market makers there was just these giant margin calls that it just kept on coming down, and liquidity disappeared from the market. And
one thing I'll add though is that it was a little bit more orderly, probably due to a lot of spot bids that are more condensed in terms of the total dollars waiting to try to spot buy Bitcoin. So probably some hodlers will sell off 20-30% of their stash, and then they put in these stink bids and they, and then they're like, whatever, I'm hodling, but here's the thing. Because they don't like the derivatives.
That's fine. But it really started to get disconnected at this point.
Well, I'm saying that first drop was a real dislocation in terms of the micro structure, especially if you look at the 5 minutes, because we went all the way from 72 to 56. This is on Coinbase I'm looking at. And that was a 10K candle in volume. And then we retraced it real quick to 67 and then retraced that. And within the hour, it was okay, we completely exhausted all the bids between 72 and 62. And then we kind of spent the rest of the day choking on that. So that dislocation is very disorderly in terms of micro market structure. But what we had in the evening was a lot of spot buying, a lot of retraces, candles that are successively bleeding lower. So this means that there was, in a sense, a functioning market. And I was participating at this time, buying and selling, quoting on September a lot and some June. Not so much perps, and there were $200 spreads in the order book, mate. So people were definitely boop boop. I'll quote this a little bit. And it was obviously for like one Bitcoin or a few Bitcoins, right?
But Bitmex is still fine at this point, right? So I'm looking at the funding rate. Funding rate kind of peaked out at about 0.8.
Yeah, it was that
0.8.
moment when we were in the low fours where
no, still in the 6,000s, right? So in the 6,000s, funding rate is at -8, and things are still fine, right?
Yeah.
Everything's fine. Funding rate kind of comes back towards like -2 or -0.2, and that's fine, right? And then in the evening session, it just got destroyed. I mean, we went from -5 or -0.5 to -7%.
Nice.
In a 5-minute candle.
I could describe this in one formulation as the conventional markets are correlated to Bitcoin, especially in times of global liquidity demand. That's, like a crisis, right? Maybe not it depends on how you calculate the correlation. There's a lot of minute debate about this, but in these times they're correlated. And then this market has a volatility limit that's built into their market structure where they're just like, hey guys, we're a bunch of civilized-ish New Yorkers. Just go get a hot dog. Like, come back in 15 minutes. Like, fuck this. It moved 5%, guys. That's crazy, right? Which, of course, in Bitcoin is a joke. Oh yeah, that's a 1-hour candle in an uptrend. Buy those dips, right? Anyway, so that structural volatility limit collided with the structural volatility limit that, in theory, you could have a perpetual swap that just will go as wide as the market takes it, right? And therefore maintains this kind of arbitrage, and thus presumably would shock further, like less far away from the index, right? Mm-hmm. But it's kind of crazy to think about, and they designed it this way pretty much taking on the math of like, okay, let's say a guy is 100x, just naked long with this, and he's looking at the funding purely as a cost of capital. We need to not liquidate him on a funding event. So they make the max funding event enough that you won't get liquidated for it if you're still hanging at break even, and thus you can get another 8 hours of like do or die and you'll be closer to liquidation. But they kind of priced it with that in mind. But if you were thinking about this as a thing where most of the people who are short are going to be largely collateralized, which is how I don't think it's that weird. I think that we'll have hundreds of billions of dollars of spot inflows buying Bitcoin and hedging it with swaps if the swaps pay, and doing it fully collateralized and treating it as dollars that pay you some decent interest rate versus negative yielding dollars or almost nothing yielding dollars that we have now. Like, let's say, like, I don't think it's like going back to round number bias is the biggest religion in the world. Negative rates don't matter that much. I mean, they matter, but the thing is, sorry, one sec. My client is trying to call me. I gotta just give him a little apology we had this scheduling conflict because it was for an hour ago, right? So we're gonna wrap up by now instead of being halfway through. But I was doing me taxes and what have you. All right, so sorry, can you reorient me a little bit? I got distracted.
Yeah, okay. So let's just come back. So at around 8 in the evening on New York time, everything just breaks. So the spreads just blow out between Bitmex and Coinbase and all the other spot exchanges. Everything goes haywire for roughly about 2 hours. That's when there's just a massive sell-off, just liquidation, just wall moving down further and further in Bitmex, and it just seemed unstoppable at the time. Right, unstoppable. And there was a point where it just went over the edge. Kind of when we went below 4,000, that's when things got just extremely dicey.
Well, yeah, all bets are off, and I was rehedging. So I had switched into covered calls in like the mid fours, and then I was opening some partial future shorts, even at the extreme backwardation. Just keep surfing it because I'm seeing the flow. So obviously I'm getting like less than half of a short coverage on my collateral by having calls open as shorts. And I had to cover that. And then I'm booking a little Bitcoin as profit. And then at 4K, I'm like, yeah, pop up above 4K. Reload a little hedge. And then when I was seeing it at 4K, I'm like, fuck it, open more hedge and be net Zelta flat again. And then it was like a quick move. And that was where we saw the tape just turn into just a complete teenage wasteland.
I know. So let's take a bigger picture here. When the market spreads like this to the extremes that it is, it's really shitty for market makers. They're the ones who suffer the most, and they just are not able to provide liquidity into the market anymore. They're the ones who are supposed to keep the spreads tight, to keep the markets together. And when they just get fucked like this, like just completely wrung out in the space of a couple of minutes, I mean, the whole market disappeared. I mean, liquidity dropped to zero. I mean, I've seen some screenshots and some videos of the books right before they pulled the plug, and there was only like $20-30 million left in the order books on the bid side.
Yeah, but I don't know if you can just extrapolate that into like, they were going to lose 30,000 Bitcoins in a massive, and the market was going to crush to $100. Come on, like,
right? No, but what happens if they can drive it down, right? If all the liquidity disappears in the swaps, right, and it completely disconnects from the spot market, and they're able to push it down to like, I don't know, a few dollars for just a few seconds, right?
Yes.
Okay,
but
that's all it takes. That's all it takes, right?
Yeah, but look, there's only going to be, okay, so first of all, in that scenario where they actually did flash crash to $10 or $8 or $100 or even $1,000, they would be in a situation where the losses systemically are so great that they're a risk to the insurance fund, and the cost of rolling back trades and compensating people is maybe less, right? So they might do that. But let's say that they honored those trades. Only so much volume is going to actually execute at those prints. Right. And, so for instance, they could update their trading engine fairly easily so that the flash crash print that could theoretically happen in a complete tail to the wall scenario might have been 1,000 instead of 100. You know what I mean? Like they can put in sort of hard circuit breakers of like 50% on the day or on the 12-hour or on the 8-hour settlement period would be smart, right? Because that's actually relevant to the mechanics of this money moving around. And have it be a 50%er, right? So they had one funding session, like it might have been, and then of course people knowing this can really arb around that, right? And be like in a time like this, but that might be smarter for them. Now, having said this, the other caveat is that the composition of that order book could have firmed up if that snapshot was taken, 10 seconds later. So unless I can see like a time series of total open interest, then I would be kind of skeptical of that being, because that was a moment, but like, look, I was on Deribit, like there was a lot of liquidity on Deribit. Like it would have just meant that Bitmex would have had this situation on their hands to manage their losses, et cetera, either procedurally from just a bail-in or probably not because of ARB. So it would have been more trying to keep the rep and paying people to keep them happy, basically.
Right.
And it might have cost them 10,000 Bitcoins. I mean, theoretically, it could have gotten worse for them. But then meanwhile, like Coinbase and Binance, Tether, unless there's like a run on Tether, right? That could be another thing. But that usually has, funnily enough, the opposite effect. In the middle, you've got people like Deribit that are pretty legit, and these legit spot exchanges. And, could we have wicked on spot to $1,800? Yeah, sure. I mean, I was hedged for it, I did start bidding when we got enough hundo handles knocked off really quick in the threes, because I just kind of YOLO'd. I just figured like, okay, dude, this is the moment. And, I had a leverage spot long on swap open when it was at a few hundred backwardation, and I closed it after like a quick, so I just wrote it spot in covered calls up to the fives. I didn't hold the leverage. Don't have enough pirate in me for that, I guess. But what a moment, man. It was a glorious moment. And then the subsequent, I've seen this movie enough times on different fractalizations of power curve volatility moves. I've seen it on the intraday hairpins. I've seen, that only move a few percent either way. We saw a few of these in the 9K range recently. So that's like your bread and butter, like eating hope to steal people's milk money kind of a deal that we see all the time in the Bitcoin markets. And then you got the more dramatic ones that are like hitting a moving average support on the daily kind of moves that are 10%. And then you've got these guys. Whatever scale it is, the pattern is sort of samey, right? So we've got kind of the Elliott wave 3 pushes here, where this last push was like very psychologically and mathematically characteristic of a wave 5 down, where everybody's selling. There's a moment where people who are even bullish at those prices are very bearish for the next 15 minutes. And then they're ready to flip, like me. So that was fortunately, it didn't get wrecked. I didn't get wrecked to going down to 2,500, right, or something. But I would have been unleveraged anyway, and well compensated by the premiums. But yeah, so whatever. But look, it was one of those. And then I figure, okay, so we got the deviations. I was getting long. Then I saw the push back over 4K to like 4180, go down to 4050. I'm like, okay, watch this for a few minutes. This friend of mine was really worried about his large spot position, and he was pinging me. He's like, "It's a bloodbath out here." I said, "No, relax. This one's looking very characteristic of a bottoming right. move." And then the way bottoming moves end up going is that you get this kind of pump to a slightly, it might be a lower high. It's usually a little bit of a higher high than the latest highs before you had that crane move. And then you'll retrace it real quick, 30%, maybe 50. And then it's like the Shoryuken, like Ryu and Street Fighter. And it was like over the next 40 minutes, really, a lot of it happened at about 20. We got all the way up to 5K and some change. And then round number bias kicks in, profit taking. Dip down to 445, and then pump it again over the next 30 minutes to 52. And then I was able to trade that. So I flipped into, I like covered some of the calls, and I like shorted more futures when they had like gotten to a low backwardation, and then we dipped and there was more backwardation. So I like covered that and sold calls again. And then we like went up, and then I like went on Telegram and traded with a guy when we were at like 55 a few hours later to buy some at the money calls. So my in the money calls would be like a max loss spread. And that therefore I could hedge futures now at a little bit of a very little negativity or very slightly positive. And then I played the next one. Unfortunately, I didn't buy the dip to 4,500. That's where my game was off. But it was a very successful night for me.
Do you think just to kind of come back to the conspiracy stuff, do you think that Bitmex pulled the plug at 35?
Yeah, I would. But I can't, because I'm issuing a peer-to-peer protocol, right?
I mean, but if you're Arthur looking at your kind of exchange,
if I could quit, I would.
Just pull the plug. You just feel like kill it.
I got my name on this open source thing, so I can't quit. It's just like, but I sort of haven't committed as much as they have operationally. My toss is that this is like, as is software that you use at your own risk kind of a deal, right? There's no fiduciary relationship. There's no custodial relationship. Whereas in his case, he's got a mountain of liabilities, and of course he's got a lot of assets to go with it, right? So it's cool. Yeah. But his bread and butter comes at a high overhead of being liable for a lot of other people's money. Yeah. And that sucks. That's a lot of stress. I can see why he would go to the mountains of Japan and learn Zen Buddhism, like it makes a lot of sense. So anyway, I think if they didn't pull the plug, given the magnet, so here's my like rational pundit counter argument, like to play. I'm not saying either way.
They're calling it a DDoS attack.
Oh, okay. So they are claiming that there was like the bottleneck got throttled, and they just had to stop processing the queue. Oh, okay. Right. So it's sort of a fact that that there was a queue, the ratio of the queue to the book arguably was very nasty, and it was just best to, instead of doing rollbacks later, just turn it off and cut the queue. And they may, instead of having a circuit breaker where the sort of low print on the flash crash might be like 1,000 something, and not be like a total nightmare, because these are inverse quoted, right? So you could actually, right, like 31,000 bitcoins at $100 isn't worth that much money. You know what I mean? So they could have done that kind of circuit breaker, and instead they have an operational circuit breaker that they obviously haven't told their HFT liquidity providers about. But probably it was ad hoc, and Arthur was just like, cut it. Yeah, exactly. Hangs up the phone and like lights some fucking incense, man. Like, yeah, I mean, maybe, but also let's look at the counter argument. So I'm going to use this opportunity to plug my thing. So with Tradelayer, instead of having all the liquidity providers, they're sort of maybe co-located in AWS Ireland or in the Strasbourg data center that Deribit uses, but they're not hard co-located. And it doesn't really matter because the stack is processing things at a kind of Three Stooges, like packets going through the door, getting into a queue. There's some latency there. Then there's the subsequent flow through. And of course, there's the infamous overload messages, right, that everybody criticizes. And honestly, like EMX had a little freeze up in this time. Deribit did as well. So I would have been remiss to go panic cover any short futures in the subsequent move up, right? So it was like when, so everybody kind of went down almost simultaneously in this overlapping half hour of like absolute extreme volatility and joy in my part. And hopefully for other hodlers who are at least cathartically relieved after a brutal day of punishment, right? So at least the catharsis, yeah, well, okay, now I got those hundreds back, whatever. So my proposal to the world is this: let's trade Bitcoin derivatives on Tradelayer. We can run our own clients. We can verify the state of transactions on the blockchain. It's not that much overhead. It's not for like a really cheap retail laptop. Get some extra RAM. You'll be fine. And then we can all be running this on our own computers. We can be controlling the majority of our assets in cold storage and having hotkeys to co-sign trades with each other. And we can create bilateral liquidity channels where we're high frequency trading with each other using the underlying signature feature of Bitcoin, right? So I'm actually just adding some logic about how things are treated as far as commits and withdrawals to the channel or transfers of capital between channels, and the trade logics. But there's no order book, right? So we had to get around this global order book, right? Which is 10 times worse for Bitcoin. And there was a backlog in Bitcoin that day as well, just to add spice to the stew. I was moving money around and annoyed by that all day. It was a really stressful day. And the following day as well. So, on-chain order books are screwed for this. A trade channel would just put in a higher block height expiration for its unsigned trades. And maybe, you do them RBF and you're in control of the fee and you just try to get them done as you please and you have some code manage that. So it's like I'm working on open source JavaScript that people can run. I want to get an NPM out for managing trade channels that algos would use on an object-oriented API kind of basis on top of the wrapper for all our RPC calls. Which I already have. And so like this is going to be where the market structure goes. And so trade channels are very good for low volatility because you can just get things done quick and you expect the dealer to countersign you and not reject your orders because they're waiting to catch a rebate and then they pay a 1 basis point fee and they've booked, and they gave away like 1 tick to you or something. And then they're booking 1 basis point and it's business as usual. So in a time like this, those channels might lock up or they would get very expensive. Then there's Litecoin. Litecoin's pretty empty. So I could see a lot of volume flocking to Litecoin and fees filling up as the blocks fill and going up a little on Litecoin. And obviously there's only so much capacity. So, it's a hard problem to do market infrastructure for a global asset. If you're doing US equities, you can have it all in New Jersey and it's fine, or if you're doing CME, it's all in Chicago. You build the radar towers, right? We're going to have forever, which is the good part. And even if we go into space and Bitcoin is still money, I think it'll be AI, cognition, proof of work. Maybe people will take the Bitcoin UTXO set and port it to that, whatever. So obviously latency would be a lot more in the future, right? In space, right?
It won't propagate. I mean, it doesn't propagate to Mars.
No, it's true. There's given the time intervals. Yeah, no, you would use your own Mars coin for sure. Bitcoin Mars, it's going to be big. Elon Musk is going to be the CEO of it. So anyways, no, but here on Earth, what you could do is you could have a satellite and you could do a relay, right? And you could try to cut out the triangulation around the physical sphere of Earth, right? I mean, it's a little ovoid, but let's not nitpick. So anyway, so there's always going to be latency. If I were doing a trade channel with another guy in Chile, my relativistic latency might be very low. It might be like 10 microseconds, right? Because he's up in Antofagasta. It's not that far away. And then we're talking about C++ logic will become relevant to trading algos, right? Because now you can make reason about this counterparty value adjustment in your unsigned partially signed transaction inventory and your unpublished signed transaction inventory, and you just do that, and you can sort of play it like it's an option, or you could try to keep your rep good, right? So that's an interesting dimension for algos. And then you can just keep trading during all this time, and we might actually have a situation where all the centralized exchanges freeze. Bitcoin has had extreme down volatility. It's having extreme up volatility. You really, really want to panic buy or cover your hedges. And this is the only way to do it because everyone else is frozen up. And yeah, you might be paying a high miner fee. You might be paying a big spread, but that's life. So at least this is my humble offering to the Bitcoin community. Here's a market structure that's based on the actual Bitcoin software. Maybe this is better. And we have insurance funds in Tradelayer. The fees go to buy back the Metacoin for the native insurance fund, and they also stock away some. If it's an Oracle, and let's say it's USDC as collateral, you would have an insurance fund that's stockpiling up USDC, right? Because these things happen, right? So obviously you need an insurance fund. You need a liquidation penalty that's big enough that under vanilla volatility bands, people cannot just open up 10 million on two addresses like the infamous Bitmex shark, and try and raid the insurance fund successfully by crashing one position and then creating enough slippage in the market to close out the other one ahead of the liquidation fee plus the slippage on the liquid. Well, you have the maximum loss already posted, right? So it's just the liquidation fee is like, we're going to go ahead and move this price up a little bit, right? But if the market slips more than the fee, then it's a facile exercise. So what everybody hates Bitmex for is having a policy of basically taking your whole maintenance margin. They're like, fuck a fee. We'll just take everything you have. Like, you're not getting our money, right? And
that's how they ended up on the day. They ended up with 3,000 more Bitcoin than they started with on the day.
Well, there you go. It's a good thing you flipped that switch, huh? So anyways, allegedly, I'm not saying he actually did. Allegedly. Yeah, allegedly. So yeah, I mean, like Deribit has had issues where they had to chip in 500 BTC because they have a fixed liquidation fee. And with Tradelayer, obviously I didn't want to do the Bitmex thing, but given that this is like a decentralized drop the mic kind of a thing for the most part, we might come out with some like feature ads, like here's a version that's backward compatible, but that adds options trading, right? So you can have these independent settlements of that. It's like we want to get the parameters right the first time and walk away and have something that's going to run for 50 years without having, I'm sure it's going to have black swan days too. And we see these little illiquid DeFi systems on ETH having a lot of blowups even before a day like this, right?
Yeah.
So obviously, in a way, DeFi is not, at least with Deribit, they can like shill out $1 million and make people whole if there's a screw up, right? But I'm not going to do that. Full disclaimer.
So one thing that's changed since the last time we talked is DeFi, right? So,
yeah.
We talked, you were telling me last time that the open interest rates on Bitmex will become the most important thing. And that's what everybody's going to talk about. And, the funding rate is extremely important, but in I guess it's about a year since we had our last interview, DeFi has just exploded, right? And
yeah, it's getting big.
Right. And the thing that everybody's talking about is the amount of ETH locked in DeFi and then also the interest rates as well too.
Yeah.
And so
I'm glad to see that. Yeah. It's going mainstream within the crypto Twitter circles, at least.
Right. So my kind of thing is that, or opinion is that the ETH guys figured out how to make a retail friendly version of what you were talking about. So
people are slowly closing in on this UX of like, here's a dollar balance, here's your interest rate, have a nice day, which is what most people want, right? Go on.
Exactly. Right. And it's, by creating a retail version that's just, you can create something in a few clicks. That's what's really driven a lot of people to embrace DeFi. Because it's something that they can say, oh, hey, do you like a high interest rate? You can get 8% by putting your DAI into Compound or one of the other contracts that they may not understand the mechanics of the contract, and they may get screwed by it, like what happened on a couple of days back when Maker just had it worked as intended, right? But when the vaults were liquidated for zero, right? So there may be issues with the contract, but at the same time, it works as intended, and they're getting they're getting what they want with just a few clicks, right? So I don't know. I mean, do you see this as something that Bitcoin's going to have to catch up on?
Yeah, and it's not going to be a problem. I don't want to sound too much like Donald Trump with the braggadocio here, but I think Bitcoin's going to clean up this competition without much of a hassle.
How though?
Okay, well, like Synthetics is a Ponzi scheme. Maker has like egregious negligent admin controls left in. All of these CEOs have like a blasé attitude about the poors. They just have too much money. They fly private, and they have RPG character names. And I'm just Pat Dugan, and I'm doing a Bitcoin multi-sig derivatives DEX. I worked with a PhD. We came up with a clearing algo, and it's got super low fees, and you can do decentralized dollars in this way with a decentralized derivatives market structure instead of a banking system or whatever. So that's my thing, and I think it's like at the end of the day. So a couple of plugs here to give two examples.
So can you create like dollars through Tradelayer?
Oh yeah. So the simple way with an Oracle would just be to create, $10,000 short, and you've got at these prices right now, it would be 13,200. I'm sorry, right. 10,000 divided by, so you got whatever the amount of Bitcoin is, the $6,600 worth, sitting on cold storage, and let's say you've got a little USDC as a hedge that you can like cycle the Bitcoin out. So that's like a little imperfect, right? And then with native, you'll be able to do it based on our Metacoin, and it'll live on Bitcoin, and it'll be as decentralized as that.
What? So you'll create a dollar out of it that people can like give to somebody else?
Yeah, we need enough Bitcoin for coin for like Metacoin volume to create a synthetic Bitcoin token that has a liquid enough spot liquidity that the derivatives contract isn't easily manipulable. And the synthetic Bitcoin is backed by that. Then you use that as collateral in native for a native Bitcoin dollar contract. And thus you'll be able to mint decentralized, what I call DUSDs, not for Dugan, it's for decentralized. It could be good. Yeah. If people want to nickname them Dugan dollars, that's fine. But I would actually prefer not, because like I envisioned this years ago as a very pure thing. The most pure thing obviously would be to wrap Bitcoin as a Lightning Network receipt of some kind, or an amassed construct, or using a new opcode. In some stages, we'll evolve into that. And then meanwhile, here's this Metacoin and here's Oracle's. And we're looking to partner with dollar coin issuers to get some dollar coins on. And I wanted to give 2 plugs to some friends of mine that's highly relevant to this conversation, hence why I'm doing it. I don't just do plugs for free. So there's a company called Value in Colombia, VALIU, that is going to they're doing remittances right now between Colombia and Venezuela, and they're going to have a dollar savings wallet for Venezuelans and other Latinos, because it's hard to get a dollar account here. And initially, it's not going to pay any interest. And I was helping them a little bit with their hedging and understanding Bitcoin term structure. And obviously, right now, there's hardly any yield to get. You can go short September and maybe pick up, 1% annualized, which is like maybe a little higher than the 10-year U.S. Treasury at this moment. So it kind of makes sense. Okay, don't worry about the interest right now, guys. Here's a stable unit of account. And yeah, it's centralized. They've got custody of the Bitcoin. They probably do a proof of reserves later on. But there's a lot of...
I heard of this company. They're using... So you make the transfer between Colombia and Venezuela, but they're doing it with Bitcoin.
Yeah, so they would buy it in Colombia, dollarize it, and then sell it in Venezuela and cover the hedge.
Yeah.
So it's simple and efficient, right? And it services real customers,
Yeah, but the customers never know that they're using Bitcoin, right?
They don't have to. And likewise, they don't have to know that their Bitcoin balance is a combination of, their dollar balance is a combination of Bitcoin and futures like EG on Deribit, for example, or on a mix of exchanges for minimizing credit risk. They don't have to know that ever. Yeah, they can just sit out, most people don't know that when you have a dollar bank account in a foreign country, it's backed by FX swaps that have counterparty risk with Citibank. You know what I mean? Like, not even educated finance people know that much about that usually. So that's a thing, and that's fine, and that can reach a lot of customers who are not sophisticated. And then on the other side of the spectrum, my friend Fran Stranyar with Brave New Coin has a Tekami Capital Tiamat sort of ETP. It's tradable on ETH. There's KYC rails, so you got to get KYC with them. It's like a proper investment product. And what they do, it's kind of like what Staked does, but Staked does it like a little more non-custodially. They take your money and they invest it in a basket of DeFi things, right? So they buy some of this coin, they stake that. I think if they can hedge it on like Delta Exchange or something like that, they'll do that. So they get yield there. And they're dealing in operational risk with the underlying software as well as the underlying blockchains, right? So if like so-and-so proof of stake chain has a real crisis, that actually represents, beyond price risk, which you can hedge, a credit risk for that staking yield, right? And if you're just doing this in Bitcoin and people want to buy Bitcoin, so there's an expectancy of positive total return at most years in Bitcoin, which there is, right? It's got the most liquidity. It's very volatile. Yes, they're not U.S. Treasury bonds, but it's a different kind of power collateral, and it's the most favored by the market, blah, blah, blah. So there's a very liquid derivatives market. You can hedge into dollars. You can get that swap rate and just chill and have a dollar base, right? While you're milking this bull market. That's just as credible, if not a lot more credible, of a way to get yield than buying so-and-so coin and bonding it and then putting on a futures contract. You have some margin issues between the bonding and maintaining the futures hedge, right? So I could see that as far as, I think what Fran's doing is really good. It's just that it's got this operational risk, right? And of course we want to diversify it and add some of these other yields, but the Tiamat fund is strictly DeFi, right? It doesn't dip into Deribit to get a yield.
Yeah.
But when there's Deribit decentralized, then it will. So I think that's a really cool product. I'd like to get them on Tradelayer with that and get them running their indexes on Tradelayer so they can include them in that basket. And Tradelayer also supports whitelist modulation if you want to do that for issuing.
And you got to release this. You got to release this soon.
Yeah. So we raised some money. We're going full time on it. We're working through this quarantine. We just got through some tickets related to fee movement. We got the KYC stuff logicked out last week, and we're moving right into QA. So we're going to be going public with testnet stuff very soon. I've been saying this on podcasts since September 2018. So discount my credibility just a little bit, but we have been working on this for 2.5 years. We ought to have something by now, right? So
Right.
it's a big, it's like a 20K plus code base, some of which is our original stuff, some of which is Omni, but we've probably contributed like 14K lines between like, and then there's the web layer stuff. I mean, it's still a lot of stuff. But yeah, I got just enough money to like pay the contractors and pay my core guys for a while. And we're going to be pushing out Oracle release first. Then we're going to try to get some of these dollar coin providers, or I'll start trading directly at a small scale with some HFT guys with our own private collateral, like something we have in Bitcoin between us. Then we're going to follow up with native release. Then we're going to follow up with the Bitcoin version release. So we're starting on Litecoin, which might not be a bad idea. It's a more chill environment as far as when you get confirmed. A lot more chill. And we might heat it up a little bit, right? That could be fun too. And then I'd like to come out with an options version subsequently, which we'll try to coordinate the two chains release. But we would always do Litecoin first. Litecoin's kind of the test net, right? And the options are going to be like, there's no order books for every option. There's no listed options. There's going to be a rule that rounds the strike and expirations to the latest day and the latest strike interval, which will be like a percentage of ticks or whatever. And so if you put in a weird strike, it'll just round it to the closest legit one. So there's like an implied options chain. And then you do everything in trade channels OTC. And because partially signing a trade channel TX is basically an American style option, I could take your signed TX and not co-sign it until it expires. And that's like a free option to me. So we have to price that in, right? But these are going to be like European style, which are cheaper. Row is a real thing in DeFi and in the Bitcoin centralized derivatives. And it's quite high sometimes. So, and this gets priced in, right? You get extra call premium when the futures have premium, right? And then you won't have so much for weekly, but if the swap rate goes up, then the calls will get a little more premium, and vice versa, right? We had extreme backwardation, puts were more expensive. So, I mean, that's sort of Row being priced in. Like Row still gets priced in to European, but then there's like a Row plus sort of that adds in more premium for an American style, which is whatever the notional is times the interest rate times the expiration remaining, right? So fuck that. Let's not pay that. Cash settled European is just fine. I don't get this whole obsession with delivery. That's so I made a few design choices to like really trim down what that feature could be. And that'll be a follow-up. And then we've got some more things we'd like to do later. For example, post some tokens as collateral in order to take on 80% of the value in some other token, and thus do a spot margin trade, right? Which is not meant for leverage, right? You got plenty of leverage in the derivatives. It's meant for arbitrage. And then it could be interesting in DeFi where people are taking illiquid assets like real estate, which is going to be in big trouble after this crisis, by the way. Commercial real estate is going to be totally hosed.
Oh, yeah.
And residential might be okay, right? So, multifamily, right? Everybody's going to, the gold standard in real estate is going to be multifamily. But of course, if people start not paying their rent, if this economic thing drags down, maybe not. But anyway, let's say residential is still good at some price, right? And the government will reimburse you if HUD says that you can't evict anybody for non-payment. So we're in this little jubilee phase, whatever. So you break even. You still get the yield, and we'll discount real estate by 30%, whatever. But then you add like 10% for the liquidity premium of creating a REIT out of normally illiquid properties, right? That's kind of why REITs are such a profitable industry. And
I mean, but
yeah,
so that's what we're doing at the company that I'm at now.
Oh, great. Are you still with the Dara, by the way?
No. I've moved on to a company called Realty. I don't know if you heard of them.
Oh, yeah. No, I saw it on your thing. Oh, that's too bad about Adara. Well, I did want to talk a little bit about this idea I had for the ultimate exchange-traded product. So basically, if you had a brokerage facility to short like buns, for example, at zero.
That's right. You told me about this last time. It was because there's negative rates. You short that. And then what are you taking the
you buy an interest rate floor so that you're hedged on the movement in the short principal, right?
Yeah.
And then
Yeah.
you subtract something for that, and then you take the proceeds and so you can't do this anywhere, but if you could, like in theory, it's something a broker could facilitate. You buy Bitcoin and you sell that with some derivative for a positive yield, right? So it's basically, we make an index, which is the difference between two indexes. One index is what's the cost of paying repo to borrow this bond, the coupon on the bond, and the annualized cost of some index of interest rate floors. You have, 3 months, 6 months, a
Right.
year, right? You have some mix, whatever. So the blended theta on that, and that is some interest rate. It's going to be like the repo is 1 point something or 2, and then the floor is like another 1 or 2, right?
Right.
And,
But
and
aren't you scared about what's been happening in the repo
oh,
recently?
that they'll well, no, but this is like this is providing some fodder for that, essentially. And giving these guys a business model to get some yield on their bonds, right?
Right.
And
Right. Right.
there's no shortage of bonds. It's a shortage of reserves, right? So to comment on that, the Fed opted to go into what they call an abundant reserves regime. You know who else went into an abundant reserves regime?
JP Morgan?
Well, sure, but going back in time a little bit, literally Hitler. What Hitler did for Germany that was good, why people supported him, is because he went full MMT, and they're not going full MMT because it's not being spent fiscally, right? It's
Right.
just a blank check to the banking sector operating now at zero reserve requirements. So it's MMT. It's like neoliberal MMT, okay? And what this means is no matter what happens, they're just not going to let the banks go bust. We're not going to, don't worry about it, guys, right? And
I mean, that's
then
what they want. That's what they want. But there's, I, I'm reticent to say that they're going to be able to keep it under control. And
well,
we'll cover that in a minute. But I'd
okay.
like to hear your thoughts first.
Well, I don't think that there is a risk of the banks going bust because I think the Fed has effectively underwritten infinite dollars worth
Dome-
of
Domestically or internationally?
domestically. Yeah,
Okay.
internationally, we could see the
Right.
euro dollar market get really weird as a
I,
next phase
it
here.
is. I mean, but it is getting weird. I mean, look at
Well,
the
there you
dollar.
go. There you go.
So what happens? What happens if we get a like 20% 20% increase in the dollar versus the euro? So we go below parity to like 0.9 or zero point 0.8 or something.
Well, everybody's been buying dollar-denominated securities largely unhedged because
Of
if you do
course,
it, it's like it's a condom, it spoils the whole thing. So
right? But
fuck the basis
but
swap, right? So I don't see that
sure,
being bad. I see that kind of bailing out a lot of like well-to-do-ish people in Europe, I guess, right?
right. But look what's been going on. I mean, so this market downturn, right? Because of the global reduction in demand, right? It's creating um, untold stress on a market which already was, teetering on the edge, right? And now people are having to cover their dollar holdings with currencies that are collapsing versus the dollar, asset prices that are collapsing versus the dollar. You would think in an environment like this where liquidity is, or sorry, the interest rate has gone to zero and banks have zero reserve requirements, you think that gold and silver and the other commodities would be moving upwards, right? But they're not. They're being heavily sold off. I mean, you look at the entire commodity space, and it's just completely just been trounced over the last few weeks. Platinum is down what, like 40% from like 2 months ago. Palladium is down from what it was Palladium peaked out at 2,800. It's now trading at 50% that.
Oof,
Yeah,
nice.
at 1,500 bucks.
Well, who needs
Silver,
palladium? Only people who worship Apollo.
but like silver's down to 12.6 after being up at $19
Oof.
just like last month.
I really
Even
feel for silver bugs. I was briefly a silver bug, then I became a Litecoin bug. You know, but
I don't get the silver bug thing, right? It's a derivative of copper mining, and copper is just a like copper is just like trading copper is just an ETF for China, right?
Sure. Yeah.
Yeah.
That's it. That's my home currency is a derivative of copper. So I don't have too many. I'm mostly dollarized, but yeah, it could be brutal.
Right.
Like if the CNY can't hold, and yeah, I mean,
but look what some of the currencies has been like the ruble's gone from in just a month, right? The ruble's gone from 60 to 80. The Australian dollar versus the dollar. Well, I mean, the Australian dollar just completely fell apart. A month ago it was trading at 0.7. Now it's trading at traded as low as 0.55. So there's some extreme stress. I mean, the pound, for God's sakes, broke to all-time lows versus the dollar.
Yeah, dollar blue in Argentina between 80 and 85 on the bid ask. Of course, it's not a liquid market, but
and this is global, right? So global dollar increase. I mean, I the people that I follow call it a dollar shortage, right? Is that you're having these margin calls all across the globe as currency declines. And people are priced in dollar debt.
Yeah, but they've seen this movie before, and they know how to run the playbook. They give everybody swap lines, and they just say yes. Like, you want to know what central banking is? Central banking is saying yes or no, and these people are going to say yes to anybody with a suit. So get your suit. Use your stimulus check, your helicopter money check to get a suit so you can get the Fed to buy into your small business that you just set up.
Okay, so if the trade of this decade is going to be the dollar, let's say we have a 3 to 5 year run in the dollar.
Obviously, Zeitgeist has to chill out a little bit before the dollar tops, right? Right. So they can. It's like when Japan. I remember when there was the tsunami, and I was thinking Japan has the strongest currency in the world. Why don't they just print a bunch of yen and like buy a bunch of gravel? And guess what they did? They fucking did that, of course, right? Like, who can resist, right? So, and obviously the Fed is like, and the government, everybody, the Democrats, the Republicans, the Treasury, they want to issue a 50-year bond. Like, talk about the trade of the century. It's shorting that sucker. I mean, come on, if that's got a decent positive yield. And no, I mean, I don't think that the dollar is going to lose its reserve currency per se. But yeah, I'm enough of a Bitcoin maximalist to say there's a non-zero probability that the reserve currency of the world may actually be Bitcoin in 10 years. And that's really weird. That's super weird. A world like that is so weird. And there's still going to be dollars. They'll just be more peso-esque or euro-esque, It won't be like the gold standard. But as far as the dollar index versus other fiats, I could see it topping out in the medium term as things calm down a little bit, based on the premise that the U.S. is actually leading the world in both international financial aid via the Fed and in fiscal stimulus, right?
And it's also the least worst place to put your money.
Yeah. Well, and people might start buying some cheap stocks in their home countries with their local assets, local currency. Take some of these dollar profits,
Right, but if the dollars if we're going to see a 20% move up in the dollar, right? So
an additional 20%,
an additional 20%. So I'm like, let's say the DXY goes to 120 over the next 3 years, right? 2 years, 3 years.
Mm-hmm.
There's just going to be a flood of money coming into the United States, right? Into property, as everybody tries to move their assets into dollar-denominated assets, so that they can gain the carry on the dollar, and then also have whatever sort of.
I bet you Joe Biden would go and do a Plaza Accord type deal and prevent that from happening. But I could maybe see what I would see Trump doing with Mnuchin, the Munch, is just issue as much longer dated debt as possible, and just take them for all they got, man, because that's their vibe. But either way, I see the U.S. government being aggressive enough. I don't think they're going to let that happen, because that's bad for business. It's not really bad. Yeah, why would they let that happen? And furthermore, Bitcoin is such a small asset. So we saw the supply. Let's discount Tether. Tether's like 4.4 nominally. Let's discount it to 2 and some change. Mm-hmm. And let's say that all of the open interest and swaps between the decent derivative exchanges got up to like almost that. It got up to like 1.8 or something. So that's a nice little, 11-year-old riding a bike kind of milestone. And then, we went off the bike ramp, and then fortunately we're wearing a helmet, some of us. So the kid's growing up. So as the kid goes through his pubescent years, or her pubescent years, let's not be preferential on gender, whatever, or it could be an alien kid who has an indeterminate hermaphroditic gender, which is even better. Because it is, right? It's kind of a weird alien creature. The open interest in Bitcoin dollarization, I predict, will continue to grow. I think the price of Bitcoin is going to be volatile. I'm hoping we dip from here so I can scoop some longs again after this trade. Yeah. But I do see it diverging on a retrace, however the path goes. I see it doing well even a year hence because it's so small. And the numbers that we're talking about, and just in terms of fiscal stimulus, are so big, and you can dollarize it. So if we get nominal negative rates, or it's like you've got these bond profits, you're holding 10 years and it goes to zero, what are you going to do with fresh inflows, right? Well, you can go over to State Street and put your dollars there and sell this derivative, or you can buy this derivative, and then you'll get delivered Bitcoin, and you keep it in this total return swap custodial relationship. And then there's this sort of weird market structure emanating off of the US or possibly other financial centers. And then the more decentralized coyote markets that are more illiquid, where the yields are a little higher. And it's this big daisy chain of like Bitcoin total return, cash inflows driving that. But the cash inflows are also driven by this cash and carry arb, right? Because it's actually a much better alternative to like investment grade opportunities. And it's a much better alternative, I think, before too long, to sitting in the bank, because you're going to be paying these pass-throughs on negative, right? And this is true in euros and yen for a while, right? So the main limiting factor, and we spent the majority of this call talking about the market structure with the derivatives, the term structure flipping aggressively, that outweighing the spot market liquidity, right? So however big this sort of derivative liquidity is, the spot market liquidity is like 1/8 of that, arguably. And like I count Tether among the derivatives as well, right? It's sort of slushy. So
yeah,
it's basically a swap that keeps the interest, or just doesn't pay it. So anyway, so obviously we have a lot of room for improvement here. And as big as these liquidations were, what we'd like to see is a lot more synthetic longs, because those guys are the heroes of the Bitcoin dollarization story. They're the ones taking the risk and sweating it out and gunning for the real big profits, which is having more Bitcoin when Bitcoin is higher, right? Who end up paying the yields, right? So they sustain the whole complex. And so we would need to see that gain both institutionally and among global retail. And when I think global retail, I don't think about just Americans getting stimulus checks. I think about, buying it through Robinhood. I think about like really poor people who are buying like a millibit, and they're holding on to that, and then that changes their life, or they leverage that and they earn some bit cents, and then that's a lot of money, right? And I really believe in popularizing derivatives trading, and that there is a time and a place for people to be aggressively leveraged speculators and change their lives being in real poverty. Like, it's worth it if you can set aside a little bit and leverage it and get the timing right. You're in a different world now. You've just shifted into a different timeline, right? And it's hard to do. You can also lose the little bit, obviously, but that's the game. So we have to grow this whole thing, and it's going to be incremental. It's not going to happen overnight. But when it is, as we incrementally roll higher, obviously open interest got whacked from this whole liquidation, right? So it has to recover first. Then we'll see new highs. And, I think that people like Pomp, maybe they get a little too bullish sometimes, and he's selling like just naked long spot Bitcoin. But people like him doing the good work of talking to the older generation and educating about these issues. And I've been trying to be this guy for Bitcoin dollarization, right? We actually play a really important part in speeding up the timetable here, because once somebody understands this trade and they understand how to minimize the credit risk, and you can minimize it quite a lot, even now with centralized exchanges, or there's a DEX protocol and it's integrated with Lightning and Bax Warehouse, and Goldman's your dealer, and they custody, they handle all the keys to that, and they give you a TSR and they pay you. I mean, geez, okay, sure. Like, that's the trade of the century, right? And that's being long the dollar. So whether the dollar is down or up, if it's down relative to other currencies, who cares? Because the amplitude of that relative to Bitcoin going up or down is the other thing. So the other trade of the century, obviously, I'm going to say this being a Bitcoin guy since 2013 and still kind of loyal despite being unorthodox, is spot long Bitcoin, man. Just hold that. So there are people get like the barbell portfolios, right? So if I'm going to get like 7% on the dollar base, why not have 93%, in dollars and 7% long? And then, went up 10x. So here's my total return. It's pretty good. 70.
Why not just go 90%, or so if you're doing that, 90-10, right? Is your barbell, right? Or 95-10?
Well, if you're a little more Jonesy, you might go 80-20, right?
So 80-20. So why not be 80% die and put that into compound or somewhere and pull, I don't know, 5-6% on your dollars, and then or on your die.
Yeah, no, people are 100% going to want to get some positive yield out of it. And why not do it with DAI? Well, there's a lot of operational risk with DAI, whereas if your Bitcoin dollarization is Goldman, State Street backed, right? Like that, this is how I see a lot of institutions plugging into it, like something of that caliber. And there's going to be higher yields in DeFi, and it's going to be more Wild Westy. So there's actual credit risk, but it's a more diffuse sort of credit risk. And it's not credit risk in the traditional sense, right? It's really operational risk, but it might as well be credit risk from most people's perspective. Yeah. I'm not a huge DAI fan, by the way. I'm not a huge compound fan. They almost got totally attacked, and they could have cleared out the whole smart contract. And I mean, so that was on a normal day. That was a few weeks ago.
Growing pains.
Sure,
right?
And my thing hasn't launched yet. I'm sure Holly, man, I might end up on Financial Times having Isabella Kozeminski talking shit about my bro flipping design approach and how, whatever. I might be in the spotlight as the little nerdy Myron Scholes who failed systemically as well. But I have paid great attention to not becoming that guy. And I feel like the guys who custodian these centralized smart contract addresses and can push updates and so on and maintain admin levers, and then and it's sort of like the general setting the key, the pin code key to the nukes to 0000, just because they're like, fuck these guys making me remember a password, like why would you allow anyway. So I see those guys as having way too much money and way too much control, and then they don't want to relinquish either. So then they compromise the decentralization. Like they could have those be more decentralized on Ethereum, with the Ethereum stack being what it is, warts and everything, than they have today. So I'm a bit of a stickler when it comes to that. It's sort of like when Bitfinex and my former board colleague, Craig Sellers, oversaw an integration with BitGo where they were going to have multi-sig segregated wallets for everybody. And it was so innovative. And it was like, wow, it's almost like a decentralized exchange, right? And then I hear about this. I think, oh, that's a great integration. 6 months later, there's a massive hack, right? 100,000 Bitcoins get stolen. And it's because they set the secondary key with the BitGo dashboard to just auto sign. Like they didn't really use, maybe I proffered that to him. He said, his comment was, it's a very sophisticated hack. And then he kind of recused himself. He didn't want to say anything. So I thought that was fishy. I was like, well, I want to know the post-mortem, man. Like what happened? Anyways, so who cares?
Yeah.
The point is these things can fail. Everyone needs to do their due diligence. Don't put more money in than you can afford to lose. But the only thing that can really have a 100% guarantee right now for this trade is what I described. You get the TSR set up with Goldman, you put it in State Street, you get loaded up into Bax inventory, and you cross-head. Goldman's dealing in these internationally, whatever, right? So the yield flows on to you a little bit. You get clipped, but you get a turnkey experience for that yield. And I think trillions of dollars could do that. And for even $10 billion. So like, that's what we've been like talking about for years, right? Now we have easily $10 billion of the stimulus check could find its way into spot BTC buys, you know?
Potentially, or it goes towards like, you know, paying for bills.
Absolutely. But I'm talking about $10 billion out of $1 trillion. Yeah. So anybody who's a Bitcoiner or
even a billion, that's
even 1 billion, it would be, let's see.
I mean, so how many people in America hold Bitcoin? It's like 7% or something.
Is it 7%? That's pretty good.
I think it's 5. I think it's somewhere between 5.
Well,
maybe. Okay, let's just go with 5%.
So a billion is 150, 829.56, blah 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 on spot right now. So
15. So if 5% of Americans hold Bitcoin, right? That's 15 million people. Let's say they take, I don't know, it's $1,000 check and they take $250, right? Times 250 that's $3.75 billion.
Okay.
It's a lot of money.
Yeah.
That's
$500K and some change taken out of it. So the float. So the thing people have to understand about Bitcoin is the float is only 7 to, in an extreme case like the 2017 high, it spikes up a few million as coins that have been held for 3 to 5 years go and cash in because the tax hit is worth it. They figured they'll get it lower on a rebuy. Yeah. So great. And then most of the time it's like 7 or 8 million because we've had a lot lost. And you got to look at like Nick Carter's charts on Coinmetrics with the sand bar. It's like a sedimentary rock. And you see like how many coins are being held for like 8 years, 9 years, you know, 7 years, et cetera. And it's a lot, right? So you got to discount those you got to discount the like 5-ish or 6-ish million that have been lost. And then, you get under 10 million in loose float, right? So it's not hard to goose this thing around. That's why Tether is able to push the bid around or put in like a 200 BTC order and have enough market impact from that to affect like 20 minutes worth of trading activity and get like a 40%, 40 point or 60 point move away from it. This is just like intraday stuff that I've observed, right? And then meanwhile, you can be making more money than what you could put on bigger size in different derivatives exchanges and flip it, right? So Tether whales can print orders in the Binance limit book and goose little moves around in derivatives and make a profit at it, which sucks. What kind of market structure is that? Anyway, rant over.
We covered a lot. We're gonna have to do another one
let me launch Tradelayer and I can talk about the foibles of what we're learning from testnet. We're going to simulate volatility with the Oracle bot in order to trigger liquidations and see what happens. So that'll be fun.
Patrick, that was fun. I know that there's never enough time. We need another hour actually. I have.
We should do this like Joe Rogan style and get like some scotch or like I did that with Marty. he gave me some Lafroig, and it was pretty good. Pretty smooth, yeah. All right, bud.
We can drink some hard seltzer.
Nice.
Nice. Yeah. All right.
Thanks, Sam. It's been a lot of fun. Cheers.
Hey, everybody. Thanks for tuning in to another episode of Into the Chain. I'm your host, Samuel McCulloch. Make sure to come and support us on Gitcoin. We have a grant up. You can lend a couple guy to support the show. I just want to thank you guys for tuning into the episode. Our listenership is growing immensely. We're really starting to blow up. I'm really thankful to all of you that tune in, check out these episodes, and listen to the guests that I have on. So I want to thank you, and I'll see you in the next one.